Thank you for watching. Please like and subscribe to our channel.
Walking into, like, the biggest, most heavily capitalized casino on the planet.
Okay, I'm picturing it.
Right, so you push through these massive gold-plated doors, and you're expecting the roar of the floor.
Yeah.
You know?
Yeah, the bells ringing, the chips clacking.
Exactly. People shouting at the craps tables. That expectation of just, like, perpetual chaotic motion is totally baked into the environment.
Right, it's Wall Street. It never sleeps.
But instead, you walk in, and it is dead silent.
Oh, wow.
Yeah. The dealers are just standing there. Cards are frozen in hand. Nobody is placing a bet. Nobody is cashing out.
It's total paralysis.
Total paralysis. And you would immediately look around and think, what do they know that I don't?
Right, like is the house about to collapse?
Exactly. Are they holding their breath?
Yeah.
Because that eerie silence, that total standstill, is exactly what we are seeing in the Congressional stock market right now.
Zero trades.
Zero trades. And today, we're doing a deep dive into the June 24th, 2026 weekly market brief to figure out why.
Yeah, because it's fascinating.
It is. Why have the politicians suddenly stopped trading? And why, in stark contrast, are the billionaire superinvestors suddenly betting the house?
Because the contrast in this data, I mean, it's what makes this brief so compelling.
Right. Okay, let's unpack this. Because what's happening on Capitol Hill and Wall Street right now tells two completely different stories.
Yeah, you have two sets of incredibly informed actors, right? And they're operating under the exact same macroeconomic conditions.
But their behavior is totally inverted.
Exactly. Completely upside down. We're looking at the raw 13F filings here and the Stock Act disclosures.
Basically trying to reverse engineer the capital flow. Right?
Yeah, of the most powerful people in the market.
And look, before we get into the actual plumbing of these trades, I want to establish a really firm boundary for you, the listener.
This is important, yeah.
Because the source material, it categorizes these trades using political affiliations.
Right, like it'll flag a party, D, or party.
It's exactly. Like for the lone congressional trade we're going to look at today, it flags party, D. And I want to be unequivocally clear here. We do not care about the letters next to these names.
Not at all.
We only care about the numbers next to their trades. We are tracking financial footprints, not political ideologies.
Yeah, if you're looking for partisan commentary, you're in the wrong place.
We are just here to ruthlessly dissect the data, the business models, and the strategy. Zero political side-taking.
Which honestly is the only logical way to approach this.
Right.
Yeah, because if you allow political bias to like cloud your reading of institutional data, you're just voluntarily blinding yourself.
You're losing money on purpose, basically.
Pretty much. And for you, the listener, understanding these massive structural moves is really about cutting through the noise.
Because financial media is just noise.
It's entirely designed to sell you panic.
Right.
Or euphoria, based on whatever happened 5 minutes ago.
Buy this, sell that, the sky's falling.
Exactly. But reading these institutional filings, it's like getting your hands on the architect's blueprints while everyone else is just staring at the facade of the building.
Oh, like that.
It shows you where the structural, load-bearing walls of capital are actually being placed.
So let's start by walking onto that silent casino floor we talked about.
Let's do it.
We opened the Congressional Trade Monitor section of the brief, and the very first data point is just an absolute void.
Nothing.
Nothing. In the 7 days leading up to this June 24th report, there were 0 congressional trades.
Which is crazy.
It is. The system actually had to automatically expand its look-back window to a full 30 days just to populate the report.
Just to find a single data point.
Right. And even looking back a full month, across the entire House and the Senate, there's only one solitary transaction.
Just one.
Just one.
And, to really appreciate how anomalous that is, you have to understand the mechanics of the Stock Act.
Right. The Stop Trading on Congressional Knowledge Act.
Yeah, from back in 2012. It mandates that members of Congress, their spouses, their senior staff, they all have to publicly disclose any financial transaction over $1,000.
Within a strict 45-day window, right?
Exactly. They file what's called a PTR, a periodic transaction report.
And usually those are everywhere.
Oh, yeah. In a typical month, you see dozens, sometimes hundreds of these PTRs flying across the wire.
They're tweaking portfolios, buying index funds.
Drawing tech stocks, yeah. So for the volume to drop to one single trade in 30 days, I mean, that is a massive statistical aberration.
And here's the thing. The data specifically flags the compliance side of this silence.
Yeah, what's fascinating here is how it spells that out.
The brief explicitly says, quote, 0 late filings and 0 conflicts flagged.
That detail is so critical.
Why? Because they usually just pay the fine.
Yeah, exactly. The penalty for filing a PTR late is incredibly minimal. Historically, it's just a standard $200 fine.
Which is nothing to these guys.
It's pocket change. So because the penalty is so low, Late filings are actually super common. Members forget or, their brokers delay the paperwork and a late flag pops up.
Right.
So the fact that the data shows 0 late filings right now means the compliance systems are functioning perfectly.
Everyone is hypervigilant.
Yes. They aren't forgetting to file. They are actively choosing not to trade.
Okay, I have to push you on the why here.
Sure.
Because is this just a coordinated blackout period? Or is this raw macroeconomic fear?
It's a great question.
Because if the people writing the legislation, the people sitting on the committees, regulating tech and healthcare and defense, if they are sitting entirely in cash or just freezing their assets, it feels like they're bracing for impact.
Well, it could be a combination of a few mechanisms. First, there's the optics mechanism.
Right, an election year.
Exactly. In election years or periods of high economic anxiety, the public scrutiny on congressional trading intensifies a lot.
Nobody wants to be on the front page for insider trading.
Right. Politicians might instruct their brokers to just pause all discretionary trading to avoid the appearance of impropriety, especially if they're passing sensitive economic stimulus or regulation.
Makes sense. But what's the second mechanism?
Uncertainty. Raw uncertainty.
The fear.
Yeah. If you're sitting in a classified briefing about global supply chain disruptions or upcoming interest rate shifts, and the data is highly volatile, the safest financial play is inaction.
Right. You don't try to catch a moving train if you don't know which direction the track is headed.
Exactly. You just stand still.
Okay, so let's look at the one person who did decide to catch a train. The lone trade in the entire 30-day window
The one anomaly.
belongs to Christian D. Menifee out of Texas. And it's not a buy.
Nope.
He didn't see a golden opportunity in the market. He executed a single sale.
Let's break down the asset.
He sold Pinterest, Inc., Class A common stock, ticker PNS.
Okay.
And the value of this transaction is exactly $32,500.
Great.
Now look, $32,500 is a down payment on a house for most people. It's real money. But in the context of institutional finance or a congressional portfolio, I'm struggling to see this as a massive, high-conviction macro play.
It's a blip?
Yeah. Why even bother executing a single $32,000 trade when the rest of your colleagues are frozen solid?
Well, you have to look at the business model of the underlying asset to derive any real signal here.
Okay, so Pinterest.
Yeah, Pinterest is fundamentally an advertising business.
Right.
But unlike a search engine, like where you type in buy running shoes and you have immediate transactional intent.
Yeah, Google knows you want to buy shoes right now.
Exactly. Pinterest relies on inspiration. Users build mood boards. They save pictures of kitchens they want to build 5 years from now.
Right, so it's way earlier in the process.
Yes. Because the user intent is further up the purchasing funnel, Pinterest is often considered tier 2 ad spend for major corporations.
Meaning if a massive retailer needs to cut their marketing budget because the economy is slowing down.
They aren't cutting Google search ads.
Because those lead directly to sales. They're going to cut Pinterest ads first.
That is the exact mechanism. Ad budgets are the canary in the coal mine for consumer spending.
That makes so much sense.
When the consumer tightens their belt, the corporations tighten their ad spend, and tier 2 platforms bleed revenue first.
Wow.
So if we look at the solitary $32,500 sale, you're right, it's not going to move the global markets.
Kind of.
But as a micro indicator, a politician in Texas deciding to liquidate a chunk of a highly consumer-dependent, ad-driven tech stock.
It suggests a serious lack of faith in discretionary consumer spending.
Exactly. The data flags this as his largest trade and top sale. He wanted off the ride.
And he was the only one moving.
Yeah.
But here is where the story takes a wild turn.
The pivot.
Yeah, because if Congress is frozen because they are terrified of the macroeconomic outlook, you would naturally assume that Wall Street is hiding under the bed too.
You would think so.
If the lawmakers are hoarding cash, the billionaires should be playing it safe. But that is the paradox of this June 24th brief. We go from a $32,000 trickle to a $43 million flood.
We pivot to the Superinvestor activity report.
Powered by the Dataroma tracking system. And the data just flips upside down. The billionaires are not phrasing.
Even a little bit.
They are deploying capital with violent aggression.
And this is the difference between a retail mindset and an institutional mindset.
What do you mean?
Well, retail investors, and honestly often politicians managing their own wealth, they retreat when the market gets murky.
They freeze, like we just saw.
Right. But super investors, hedge fund managers who command billions of dollars in client capital, they view market murkiness as a mispricing event.
They smell blood in the water.
Exactly. Their entire business model relies on finding assets that the broader market has incorrectly priced due to fear.
Which brings us to the headline shocker of the brief.
Number 1 on the list.
The number 1 super investor buy, David Einhorn of Greenlight Capital.
Legendary guy.
Yeah, Einhorn is legendary for his deep value contrarian plays. And he's backing up the truck for Peloton Interactive. ticker PTON.
The home fitness company.
The quintessential pandemic darling that crashed back to Earth.
It crashed hard.
Really hard. But here's where it gets really interesting. The metric that jumps off the page isn't just the ticker. It's the sheer velocity of the accumulation.
The activity column.
Yeah, the activity column states Einhorn increased his position by 4,003.68%.
A 4,000% increase.
He didn't just add a little to average down his cost. He fundamentally restructured his fund's relationship with this asset.
He went all in.
And I look at this stock price in the Deep Stock Research table. It's sitting at $5.44.
Right.
I mean, a 4,000% increase isn't just tweaking a portfolio. That's building a mountain out of a molehill. Why go this hard into a stock price at $5.44?
To understand Einhorn's mechanism here, you have to look at the valuation metrics provided in the report. Or, well, rather, the lack of them.
Yeah, there's a lot of blanks.
The PE ratio, the price-to-earnings multiple, is listed as NA. Earnings per share, or EPS, is also NA.
Okay, I want to pause you right there because we see NA all the time in these reports.
All the time, yeah.
Explain the actual math behind that for the listener. Why does the system refuse to give us a number?
Sure. So the price-to-earnings ratio is the foundational metric of traditional stock valuation. You take the share price and divide it by the earnings generated per share over the last year.
Basic division.
Right. If a company's stock is $100 and they earn $10 a share, the PE is 10. You're paying 10 times earnings.
Got it.
But what happens if the company is losing money? The earnings are a negative number. You cannot meaningfully divide a stock price by a negative number to assess its value. The formula just breaks.
So the system outputs NA.
Exactly. It tells you mechanically that the company is burning cash. They have no profits to measure against.
And the profit margin listed in the brief confirms that. It's 0.0095. Not even 1 full percent. So Einhorn is buying a company that makes basically zero profit, has negative earnings, and a stock price hovering in the single digits.
Sitting right near the bottom of its 52-week range of $3.65 to $9.20.
To anyone with a standard brokerage account, this looks like setting money on fire.
It does. It really does. If you are valuing Peloton purely as a hardware company that sells expensive stationary bikes.
Which is how everyone thinks of them.
Right. During the pandemic, their supply chain collapsed, they overordered inventory, and demand plummeted when gyms reopened.
Everyone went back outside.
Exactly. The market punished them as a failed hardware manufacturer. But if we connect this to the bigger picture, Einhorn isn't valuing the hardware.
What's he looking at?
He is looking at the trapped subscriber base.
The software subscription.
Yes. The SaaS model, software as a service, this is the textbook definition of a contrarian distressed asset play.
Okay, explain that.
Peloton has millions of highly engaged, affluent users paying a monthly premium for the content regardless of whether they are buying a new bike.
Right, they're paying $40 a month just for the classes.
Einhorn is executing a classic sum of the parts valuation. He is likely calculating that the software revenue alone, combined with the data of that user base, is worth significantly more than the current $5.44 share price implies.
So the market is just ignoring the software.
He's betting that the market is overweighting the hardware failure and completely underweighting the software stickiness.
Like maybe he envisions a tech giant like Apple or Amazon acquiring Peloton simply to absorb those millions of credit cards on file.
It's very possible. He's betting on a turnaround that the broader market hasn't priced in yet.
That makes the thesis incredibly clear. He's not buying a bike company. He's buying a distressed software company.
Exactly.
But let's contextualize the risk here because the numbers are huge. The brief shows the total value of Greenlight's position is now $43,389,000.
A lot of money.
For an individual, $43 million is lottery-level wealth. But the data reveals the portfolio weight is only 1.36%.
And this is the concept of risk parity and position sizing.
Even with a 4,000% increase, Einhorn is capping his exposure at just over 1% of his total pie.
Right. It's a calculated, high-conviction risk, but sized appropriately for a billionaire's fund.
So if his thesis is completely wrong, and Peloton goes bankrupt and the stock goes to absolute zero, his fund loses 1.36%.
Exactly.
It's a bad quarter, but it doesn't sink the ship.
Exactly the opposite of sinking the ship. It's calculated asymmetry. He caps his downside at 1.36%, but what happens if the turnaround succeeds or an acquisition is announced at $15 a share?
The stock triples.
His $43 million bet turns into $130 million.
Wow.
He's basically buying a call option on a turnaround, utilizing the massive scale of his fund to absorb the volatility.
So Einhorn is diving into the distressed tech dumpster looking for diamonds.
That's one way to put it.
But as we move down the list of the top 5 buys, the narrative fractures. Not every billionaire is chasing beaten-down turnarounds.
No, the strategies diverge wildly here.
Right. The very next manager on the list is executing a strategy that is the polar opposite of Einhorn's. We are looking at Lee Ainsley of Maverick Capital.
Oh, yeah.
And he is engineering what I can only describe as a massive defensive mode.
The contrast is jarring, honestly, and it tells us a lot about how different managers view the upcoming macroeconomic cycle.
So Ainsley's top buy is McDonald's Corporation, ticker MCD.
Burgers and fries.
He increased his position by 261.68%. He now holds over $91 million worth of McDonald's, making it 1.06% of his portfolio.
A huge move.
And look at the metrics the brief provides for McDonald's compared to Peloton. The price is $271.66.
Sitting comfortably within its 52-week range of 270 to me is the profit margin. It's 0.316.
A 31.6% profit margin.
Yes. Let's break down why that specific margin acts as an inflation-resistant shield.
Okay, so think about it like this. If you run at a grocery store, your profit margin might be like 2%.
Super thin. That means for every dollar you take in, you keep 2 cents. If the cost of wholesale food goes up due to inflation, you have to immediately raise your prices to the consumer, or you go bankrupt instantly.
Because your margin is too thin to absorb the shock.
Exactly. But McDonald's keeps nearly 32 cents on every dollar.
So when the cost of beef or labor goes up, a company with a 32% margin can absorb some of that hit without terrifying their customers with massive menu price hikes.
They have real pricing power. And furthermore, McDonald's isn't really just a burger company.
Right, it's real estate.
It is one of the largest real estate companies in the world. The franchise model means the local operator takes on the operational risk, while the corporate entity collects rent and royalties.
That's probably it.
Ainsley is taking $91 million and parking it in a global real estate and royalty engine that yields a 2.61% dividend while he waits.
He's buying a bunker.
A very profitable bunker.
And he reinforces that bunker with his second buy, Danaher Corp, ticker DHR.
Another fascinating play.
He bought 819 shares, making it 1.81% of Maverick's portfolio, valued at $155.4 million.
Serious capital.
Danaher operates in life sciences and diagnostics, and the data says they have a 14.9% profit margin.
The Danaher play is a bet on the razor and blade business model in the healthcare sector.
Oh, explain that.
So Danaher builds the highly complex, expensive diagnostic machines used in hospitals and labs. That's the razor.
Good.
But the real money is in the proprietary chemicals, the testing kits, and the maintenance contracts required to run those machines every single day.
Those are the blades.
Exactly. No matter what the stock market is doing, hospitals have to run blood tests. Ainsley is buying recurring, non-discretionary revenue streams.
I want to pause on this because it's vital for you, the listener, to absorb.
It really is.
If you are managing your own 401k or IRA, you constantly hear financial media telling you to buy the dip or rotate to safety.
Buzzwords.
Right. But this data shows you what that actually looks like mechanically. Maverick is building a portfolio designed to survive a brutal economic winter.
Blue chip safety nets.
Exactly. But just as I think I understand the safety trend, the brief throws another curveball.
Of course it does.
We have 2 more buys in the top 5 that look a lot more like Einhorn's distressed playbook.
Because the market is never monolithic. Where Ainsley sees the need for a bunker, Viking Global sees an overreaction.
Viking Global made a $150.1 million buy into Lululemon, ticker LULU, the athleisure brand.
Yep.
But look at the 52-week range here. The stock peaked at $252.24. The absolute floor for the year was $104.44.
A massive drop.
And the current price in the brief is $108.92.
So they're catching a falling knife.
Right. Buying Lululemon right now is like buying a luxury house simply because the front lawn is on fire.
That's a great analogy.
The broader market is panicked by the flames. Retail investors are selling because the quarterly earnings missed projections by a fraction, or because inventory levels ticked up slightly.
They are pricing in the fire.
But Viking is looking at the foundation.
The foundation here is the brand moat. Unlike typical apparel companies that rely on wholesale distribution through, department stores, Lululemon is primarily direct-to-consumer.
They own the relationship.
They control their pricing, they rarely discount, and they have incredibly high margins for the apparel sector.
The brief lists their profit margin at 13%.
Which is fantastic for retail. Viking is calculating that the market has punished a premium, highly profitable brand as if it were a failing mall retailer.
So they're stepping in right at the absolute 52-week bottom to acquire premium cash flows at a steep discount.
Exact.
Which leads us to the final and perhaps most intellectually demanding buy in the top 5.
This one is wild.
Howard Marks of Oaktree Capital Management buying YPFSA. He bought $40.9 million worth of the stock.
Howard Marks is a legend.
He wrote the literal textbook on distressed debt and market cycles. When Oaktree moves, the entire institutional world pays attention.
Absolutely.
But I'm staring at the YPF metrics in this data table, and the profit margin is negative 0.0182.
They're losing money.
It forces you to rethink how value is constructed. Why does a billionaire legend buy an energy company operating in the red?
Because it violates the very premise of fundamental investing we are all taught, right?
Yeah. You buy companies that make money.
You buy companies that generate cash unless the physical assets sitting on their balance sheet are mispriced due to geographical or political risks.
Oh, okay.
YPF is an Argentine energy company. They control massive swaths of the Vaca Muerta shale formation, which is one of the largest untapped oil and gas reserves on the planet.
So Oaktree's not buying YPF for its current quarterly cash flow.
Not at all. They're executing a hard asset play.
They are valuing the oil in the ground, not the cash in the bank.
Precisely the mechanism. Howard Marks is looking at the geopolitical landscape, the global demand for energy, and the potential for regulatory shifts in Argentina, and he is concluding that the sheer physical volume of hydrocarbons YPF controls is worth exponentially more than the current battered stock price.
That requires a stomach of steel to endure the volatility.
It does, but that is the Oaktree playbook. Find intrinsic value hidden beneath layers of distress.
So if we look back at the listener, right, are you looking for the safety of a 31% profit margin like McDonald's, or the adrenaline of a beaten-down stock like Lululemon?
It's two completely different ways to play the exact same market.
So we have the buy side mapped out.
Yeah.
We have Einhorn buying crab subscribers in Peloton, Ainsley buying defensive moats in McDonald's and Danaher, Viking buying brand resilience in Lululemon, and Marks buying hard assets in YPF.
All brilliant in their own right.
If that was the entire brief, it would be a masterclass.
Wait.
But the buy side is only half the story.
Right.
And when we flip to the top 5 Superinvestor sells, the data reveals an absolute earthquake.
It is the most cohesive, violent signal in the entire document.
I honestly had to read this section 3 times to ensure I wasn't misinterpreting the columns.
It's that crazy.
I am looking at the top 5 largest liquidations in the entire market brief.
Yeah.
And every single one of them, all 5, were executed by the exact same manager.
Lee
Ainsley of Maverick Capital, the very same fund that we just saw building the McDonald's and Danaher bunkers, is responsible for the 5 largest sell-offs in the entire ecosystem.
To see one fund dominate the distribution side of a decentralized report like this is incredibly rare.
It's like watching a team general manager trade away their entire starting lineup in one afternoon. What is Maverick doing?
It indicates a systematic, aggressive shift in their macroeconomic thesis.
Let's read the victims list, because the sheer scale of the destruction is staggering. These are not trims, they are total capitulation.
Complete liquidations.
Number 1, the Walt Disney Company, ticker DIS. Ainsley reduced his position by 98.97%.
It's massive.
The value remaining is a paltry $705,000. Number 2, Roblox Corp, ticker RBLX, reduced by 97.58%, remaining value. 707,000%, by the way.
And Roblox has a profit margin of negative 20.7%, by the way.
Dismal. Number 3, FedEx Corp, ticker FDX, reduced by 92.09%. Number 4, Academy Sports, ticker ASO, reduced by 90.79%. Number 5, Quest Diagnostics, ticker DGX, reduced by 88.47%.
The first mechanical question you have to ask when looking at this data is, why leave anything at all?
Yeah, that confused me.
Why drop a position by 98.97% and leave $700,000 in the account? Why not just hit the button and sell 100%?
It does seem needlessly complex. If you hate the stock that much, liquidate it entirely.
Well, it is a quirk of institutional portfolio management software.
Really? Like a tech issue?
Sort of. Funds use these massive data aggregator systems like Aladdin or Infusion. If you sell 100% of a position, the ticker drops off your active dashboard. The live data feed just severs.
Oh, I see.
But by leaving a 0.01% stub position, the ticker remains active on the trading desk monitors. The analysts assigned to that sector keep getting the telemetry.
That is fascinating.
Maverick is essentially saying, we are pulling all of our capital out of this burning building, but we are leaving one camera inside to monitor the flames in case we want to buy the empty lot next year.
That is a brilliant piece of market mechanics. But let's look at the actual companies they are dumping.
The underlying businesses.
Disney, Roblox, FedEx, Academy Sports, Quest. They dumped entertainment, gaming, global logistics, retail sporting goods, and healthcare diagnostics all at the exact same time.
It's not a commentary on just one sector.
Right. It isn't a targeted strike on one bad CEO. It is a carpet bombing.
You have to find the common denominator. Let's break down the mechanics of the targets.
Okay.
Disney is heavily reliant on discretionary consumer spending, right? Theme park vacations cost thousands of dollars, and they are bleeding cash trying to win the streaming wars.
People cancel Disney Plus when money gets tight.
Exactly. Roblox is a gaming platform that the data shows has a profit margin of negative 20.7%.
Likes.
In a high interest rate environment, a company losing 20 cents on every dollar is toxic. Academy Sports relies on people having extra cash to buy kayaks and baseball bats.
So they're executing a targeted strike against the consumer's wallet. They believe the consumer's just tapped out.
Yes, but the FedEx sell-off is the true macro tell here.
What?
FedEx is considered a bellwether for the global economy. When factories in Asia manufacture less and consumers in America order less, FedEx ships fewer boxes.
Right.
Their parcel volume is a direct proxy for global GDP. By slashing their FedEx position by 92%, Maverick is betting on a tangible slowdown in the physical movement of global commerce.
Wow. And when you look at the entire board, the plumbing of the Maverick portfolio becomes incredibly clear.
It's a closed loop.
They liquidated the consumer, the money losers, and the global shippers. They freed up hundreds of millions of dollars in cash. And where did that cash go?
It flowed straight back into Section 3.
Exactly. They used the cash from the Disney and Roblox sales to fund the purchase of McDonald's and Danaher.
It is a systemic portfolio clearing, a massive, real-time defensive rotation.
They sold volatile or stagnant assets to buy massive safety and cash flow.
They sold volatility and consumer dependence, and they bought inflation-resistant margins and non-discretionary healthcare. It is an absolute masterclass in how institutional capital prepares for a storm.
It really is. But here's the thing. If you have a standard 401k, you almost certainly own a piece of Disney or FedEx through an index fund.
Without a doubt.
So when a manager managing billions of dollars decides to dump 98% of his holding in those companies, he is actively betting against the cornerstone of the average person's retirement account.
Which is a sobering thought.
Which brings us to the final and, frankly, most infuriating section of this brief, the information gap.
The disparity between what the public is told to do and what the smart money actually does.
Exactly. Because the Deep Stock Research table includes a column for analyst ratings.
Wall Street consensus.
Right. These are the consensus opinions of Wall Street professionals. Analysts at major banks whose entire job is to study these companies, write reports, and issue buy, hold, or sell ratings to the public.
Yep.
Let's look at the Disney disconnect because it's the wildest stat in the brief. The data shows that Wall Street analysts currently give Disney 21 buy ratings, 2 hold ratings, and only 1 single sell rating.
21 buys.
21 buys. The consensus is overwhelmingly bullish. They are telling the retail public that Disney is a fantastic place to park their money.
But we just saw the truth.
We just proved that Maverick Capital, operating with the best data money can buy, just dumped 98.97% of their Disney stock. The brief actually flags the signal as a red distribution.
Right.
So if 21 professional Wall Street analysts are screaming buy, how does a billionaire hedge fund manager look at the exact same company and hit the sell everything button? Who is lying here?
Well, nobody is technically lying, but the incentive structures are entirely different.
How so?
You have to understand how the sell-side machine works. An analyst at a major investment bank is part of an ecosystem that relies on corporate access and investment banking fees.
Okay, follow the money.
Exactly. If an analyst slaps a sell rating on Disney, the Disney CEO might refuse to take their calls during the next earnings cycle.
They lose access.
And more importantly, when Disney wants to issue billions of dollars in new bonds, they aren't going to hire the bank whose analyst is currently trashing their stock.
Oh. So the analyst is financially disincentivized from telling the truth if things look bad.
They are incentivized to maintain relationships. Therefore, analysts' ratings are notoriously lagging indicators. They base their models on the company's past quarterly expectations and the CEO's forward guidance.
They're looking backward.
Right. It takes an absolute catastrophe for a consensus of 20 analysts to downgrade a blue-chip stock to a sell.
But a super investor like Lee Ainsley doesn't care about the Disney CEO's feelings.
Ainsley's only allegiance is to his fund's profit and loss statement. He manages actual billions he thinks in multi-year horizons. He is on the buy side.
If he loses money, his firm dies.
Exactly. If he loses money, his clients pull their capital. He requires liquidity. If his model suggests consumer spending is going to crash in 6 months, he has to move hundreds of millions of dollars out of Disney today.
He can't wait.
He cannot wait for the analyst to figure it out, because by the time they downgrade the stock, the price will have already collapsed and his capital will be trapped.
Which perfectly explains the reverse scenario in the data with Lululemon.
Yes. The accumulation side.
Viking Global made that massive $150 million buy on LULU. The signal is a green accumulation. But what does the analyst consensus say?
What's the number?
A staggering 29 hold ratings, only 2 buys and 1 sell.
The analysts are sitting squarely on the fence.
Completely paralyzed. 29 holds is the definition of analytical paralysis.
They're waiting for the smoke to clear from the burning lawn before they tell anyone to buy the house.
But while they are paralyzed, the superinvestor backs up the truck.
What's fascinating here is that the accumulation and distribution signals in the data are actively defying the consensus. The smart money moves before the analysts change their rating.
Right. The hedge fund accumulates the asset at the absolute bottom, while the analysts issue holds.
Exactly. And over the next few quarters, the stock price naturally rises because of this massive institutional buying pressure.
And then what happens?
Once the stock is already up 30%, the company reports better earnings. Then the 29 analysts finally upgrade the stock to a buy.
And when the retail investor reads that buy rating on Yahoo Finance and logs into their brokerage to buy the stock, Who are they buying it from?
They are buying it from the hedge fund manager, who is cashing out the 30% profit he made while the retail investor was waiting for permission.
Wow. That is the most brutal, clarifying mechanism we have uncovered today.
It's the reality of the market.
The analyst ratings are just the noise engineered for the public. The 13F Superinvestor trades are the actual signal.
Yes.
If you only followed the consensus in this brief, you would be buying Disney while billionaires are liquidating it, and you would be ignoring Lululemon while billionaires are aggressively accumulating it.
The data proves that to achieve extraordinary returns, you cannot act on ordinary consensus.
Man, we have covered an immense amount of ground today, pulling apart the machinery of these institutional moves.
It's been a journey.
It really has. We started with the utter silence of the congressional traders, a perfect compliance record, obscuring a total lack of market participation.
Save for one lone politician in Texas.
Right. Selling $32,500 of Pinterest ad revenue stock.
A micro indicator of consumer weakness that really set the tone for the entire brief.
From there, we watched the superinvestors attack the volatility. David Einhorn structuring a 4,000% contrarian bet on the trapped software subscribers of Peloton.
Viking Global stepping into the Lululemon flames to buy the brand moat.
Howard Marks ignoring negative profit margins to buy the hard hydrocarbon assets of YPF in Argentina.
And of course, the great Maverick capital exodus.
The ruthless portfolio spring cleaning, liquidating 90 to 98% of their exposure to entertainment, gaming, global shipping, and retail, just to fund a massive $250 million defensive rotation into the high-margin, inflation-resistant safety of McDonald's and Danaher.
All while completely ignoring the lagging advice of Wall Street consensus analysts.
It is a masterclass in capital allocation, risk parity, and macroeconomic forecasting. Before we sign off, I must reiterate the disclaimer provided in the source text.
Very important.
This data, and our exhaustive mechanical breakdown of it, is strictly for educational and analytical purposes.
Yeah.
It is absolutely not financial advice.
Past performance of these funds is not indicative of future results.
You must always conduct your own fundamental research before deploying capital into the market.
And as you conduct that research, I want to leave you with one final thread to pull on.
Oh, what's that?
We have spent this entire deep dive decoding the footprints of billionaires. But remember, the structural reality of 13F filings, they are inherently backwards looking.
What do you mean?
The SEC allows funds 45 days after the end of a quarter to report their trades. The data we are analyzing in this June 24th brief reflects decisions that were likely executed weeks, if not months ago.
Right. They filed in mid-May, and we were reading it in late June.
Exactly. The massive defensive rotations we discussed have already happened. So as you log into your 401k this week and look at the market, ask yourself, are you trading on today's noisy headlines? Or are you trying to decode the footprints of billion-dollar decisions made weeks ago that are only just now reshaping the market?
Are you reacting to the shockwaves, or are you looking for the fault lines?
That's the real puzzle.
That is the ultimate question. Are you staring at a silent casino floor, or are you figuring out where the high rollers just move their chips?
Exactly.
Thank you for joining us on this deep dive. Keep questioning the consensus, keep looking past the noise, and we will see you next time.
you.